edition of the NPC Markets Morning Call, Monday, 8th of September 2025. Now, the all-important payrolls numbers were on Friday night there. The market was really celebrating on Thursday night, weaker jobs numbers, but it's really been broken up by the recession fears police now. And look, I think we are going to start to see a little bit of reality check come in for markets overall. So as you can see here, these are the payrolls numbers over the last, since December sort of 2020, the last time we had a negative number. We've now had a negative number, albeit via revisions in June. And as you can see, really clear downtrend here, but not to mention the fact that there's also concerns around wage inflation as well. So US jobs data, significant weakness, only 22,000 jobs added. And let's face it, they will probably be revised down next month, probably to another negative number. The way that the trend's been, all of these numbers back here were revised down really heavily in April, etc. And we had the unemployment rate ticking up slightly to 4.3%. So that was in line with forecasts. But yeah, the weaker numbers are fueling speculation. Obviously, the Fed will move to cut rates, but they're also looking at potentially, rates being cut by 50 possibly, although average hourly earnings rose 0.4 on the month to 3.7% year over year to 31.46. So, and the average work week held steady at 34.2 hours. So I dare say that wage inflation is going to really put the Fed in check, and that means they can't go 50 overall. And that's, they do have two mandates over there. They do have to take care of both employment and inflation. So it's not weak enough to justify really an aggressive 50 basis point cut. The likes of Morgan Stanley tend to agree with me as well. We've got a Fed blackout period now for the next couple of weeks, leading into the meeting on the 16th, 17th. So, look, there's going to be a lot of speculation. What is going to happen is a lot of these sort of weekly jobs numbers that you probably never heard of, ADP, JOLTS, job openings, etc., are going to be massive focuses now, which traditionally they haven't been overall. And without the Fed being able to speak, there's going to be a fair bit of speculation around around rates over the coming couple of weeks. We've probably got 9 days until we get that announcement out. So 9 to 10 days, and there'll be a fair bit of whipsawing because there is a fair bit of celebration. Well, there was on Thursday night about, yay, we're going to get rate cuts. But what you've got to realise is that first rate cut is never for a good reason. It's for weakening jobs markets. Basically, when the jobs market goes, that really hammers it really underpins the entire economy. If people have got jobs, we can sort stuff out just generally with tinkering with monetary policy, etc. People don't have jobs. You start to see credit defaults, you start to see business models, you start to see the consumer get smashed. So it's not good for anyone. It's not good for the people. It's not good for businesses overall. And there's no real amount of AI spending that's probably going to save that. We did see that commentary from Salesforce last week as well, which, some may say I'm putting a little bit too much focus on, but those guys are at the pointy end of the AI, and they even saw companies starting to back off their AI spending a little bit. I've noticed from our point of view here at NPC Markets, we use a lot of AI. It's getting a lot more expensive. We're getting, what we used to have for very small prices is now being pushed out as you get stuck in enterprise and you got to pay per seat. All of a sudden, prices are tripling, quadrupling, and they're sort of starting to go for little bits of money grabs here and there, which is, to me, is a massive sign that that they're struggling. If it was just an absolute boom, and they would they wouldn't feel the need to just be jacking up prices as like I said, 300-400% in some from some particularly GPT. And everyone's moving to push people into those enterprise models. So Microsoft and those guys have already been doing that and making you pay as we go along. But, all of a sudden, you're starting to see, there is clearly fears of margins or margin concerns with that CapEx that's going to come up. Otherwise, they wouldn't be, you would expect 30 or 40% price increases, not 300%. As you can see here, Microsoft, Nvidia, the two of the biggest names, they were off. Oracle's coming into earnings tonight, overnight in the US, or early in the week this week. The banks got hit because I would say on recession fears, very cyclical there, as did the oil companies. Broadcom was up just on the back of, we discussed Broadcom on Friday's morning call, and essentially at that point there must have been something said in the earnings call, because it was basically flat after the earnings results. We went through the cash flow, but there must have been something said on the earnings call, because they rocketed to be up about 6% in pre-market, and then nearly 10% overnight. So I think that probably helps Oracle as well. And yeah, we've got but overall, we've got, I would say, by the look of this heat map, cyclical fears about the economy overall. The bonds did go, the bonds did really get sort of hammered in terms of yield. We had about, I think we had a drop of about 7 to 10 basis points across the board in most of those. That usually does pick up this part of the market in particular, that growth part. But I think that is starting to now shift to being worried that the Fed's balancing act isn't going to be so easy overall. But all of these moves really were pre. The Dow was down a half. The S&P was down. That NASDAQ was really probably only saved by Broadcom and Oracle, to be honest. And the Russell does benefit from definitely benefit from rate cuts. And look, the smaller end of the market's not that expensive. But look, I would expect there be, as you can see here, the Euro stocks were open when that payrolls number came out, and we've got the big end of town getting hit now. So the SPI wasn't down a hell of a lot. Anything tied to Asia is not going to be as affected. So the SPI was down probably, I think it was around about 0.2%, maybe down 15, 20. I don't really expect too much out of us. But look, this strong buy here, I think, is probably fairly overextended. And any signs, we've got inflation numbers this week, particularly out of the US. As you can see here, PPI on Wednesday, CPI on Thursday, ECB rate decision, and GDP in the UK. But look, and we've got no Fed speakers this week at all. Not much in the way of. We probably should have employment numbers, I would have thought, but it may be pushed back to next week, given the lack of funding there at the ABS. But usually it was on the second Thursday of the month, but it may have been pushed to the third Thursday. But the only real names here are Adobe and Oracle. We did have some decent results from DocuSign and Samsara, and Tesla gained. They outlined a bold new compensation package for Elon Musk, which is kind of over a really ambitious milestones. It could ultimately be worth up to $1 trillion valuation if Tesla's valuation reaches 8.5 trillion in the next decade. It's a little bit of give and take there. He is the driving force of that company, and I don't see 8.5 trillion over the course of the next decade being a remote problem, to be honest. That robotics part and that self-driving part, which has been really key in championing and getting forward, I think is so much bigger than everyone is giving it credit for. So particularly over a decade, we've seen $7 trillion be added to these, the major players in in the Mag 7 and AI in the last like 2 years. So look, if he does manage to corner robotics, or that's fully self-driving cars and robo-taxis start to take off, that's a pittance, particularly when you've got a Fed that's going to eventually, as they always do, print their way out of trouble if this is a recession. So I wouldn't be concerned about that at all. In terms of being priced in US dollars, whether the US dollars worth the same in 10 years' time is a completely different matter, given that spiraling debt. So, and obviously that brings me to still pretty bullish gold and still pretty bullish silver. I really can't see. Look, we've got this government shutdown talks probably coming onto the radar in the next couple of weeks. There's not much the Democrats can really do about it, but they do tend to love to make a circus out of this. There probably isn't a point of having a debt ceiling if they just keep raising it, but it's a bit of fake discipline, I suppose. But look, those precious metals there. I mean, copper is a bit of is a bit different because there's very much industrial. So you'll probably see copper and platinum not rally quite as hard. But that US dollar was largely flat for the week, but overall it was down 0.5% on Friday. But look, we could see a pickup in copper demand on the back of the Chinese property market recovering potentially. I think the AI demand will probably take care of that completely, but the initial moves, because that's what we've always done, will be to sell copper, despite the fact that it's at really low levels at the moment. So we saw a couple of those sort of growth, coal, lithium sort of head back a little bit. Uranium at least held its ground. Bitcoin, grinding higher. But these stores of value, I would say, are going to be pretty sought after, because I get asked a lot, particularly we just sold an investment, a 12-month investment in gold and silver, particularly coming off the back of a very successful one last year, which was leveraged and got a 200% return on investment for our clients. But everyone's asking sort of, well, can it go again? And we answer a question with a question: is, do you think the US government's going to get its shit together, basically, excuse my language, but in the next 12 months with the debt? And everyone, the overwhelming response is generally laughter, and then followed by, well, no. So, and then by default, that answers your question. I mean, silver particularly, I think, has got significant upside. Gold probably less so, but the gold miners are still extraordinarily cheap. I really can't see there being a key reversal in gold. And if there is, I think the gold miners are still making extraordinary, record margins. So I don't think there is much downside necessarily in the gold miners. But yeah, and with Trump sort of still throwing, random hand grenades everywhere. We had Israel launching strikes over the weekend. I think there was one of the most significant attacks of Kiev over the weekend as well, from Russia. 40 odd missiles made it in, apparently. So depending on which news reports you took, you can see. I honestly don't see too much easing of geopolitical pressures overall. And I mean, what Trump's effectively done by starting tariff wars is made people a lot more nationalistic, because what's good for the goose is good for the gander, I guess. So yeah, look, overall, we're still sort of seeing safety there. We're still sort of seeing safety in those defense stocks overall. And we'll be very closely watching, because if they start talking about stagflation, and that is a dirty word for equity markets, if we start talking and you start hearing the word stagflation a lot, that is not good for equity markets. Higher inflation and slower growth is an absolute disaster for the economy and for equity markets overall. So, just be wary of how, if you're starting to see those, if you were starting to see that be brought up quite a lot, then I'd start to be a little bit concerned. So credit spreads have widened a little. It's still in the low region, but it is, it is kind of heading a touch higher. We're going to keep a really close eye on that overall. I might start to put that chart that I watch in the morning report, because if we start to see credit spreads blow out, that means that people, that means that there's default starting. Then look, we're going to have, we're going to start to have trouble. So still maintaining our view here that, we're overall that this is not a bad time to be returning to cash, and we'll be very much wait and see. And look, every chance I can, the way this market's behaved in the last 4 or 5 years, every chance I can be wrong here. And I'm not saying sell down your whole portfolio, but anything that you're not too concerned about, that you're a little bit concerned about, is probably not the worst idea to be taking it off the table, because you don't want to get stuck with it. You want that cash to be able to buy some decent bargains if we bounce out. So that wraps up this morning. I hope everyone has a great day, and we'll speak again tomorrow morning.